Hi, my name is Carla Carderera, Managing Partner of Upfront CPA. Did you know that the IRS allows business owners to legally receive tax-free income from their business or from their own business? This strategy is called the Augusta Rule, and it comes from Internal Revenue Code 280E. Too much information, but it is important for you to know. It was originally created for homeowners in Augusta, Georgia, who rented their homes during the Masters Golf Tournament. Congress decided that if someone rents their home for fewer than 15 days per year, they don't have to report that income personally. Today, business owners can use the same rule as a tax strategy, and here's how it works. If you own a business and you own your home, your business can rent your personal residence for legitimate business activities such as board meetings, strategic planning sessions, annual company meetings, staff training, client presentations, or even leadership retreats. Your business pays you a fair market rental rate for the use of the space, and the business deducts the expense, and you personally receive the income completely tax-free. And that creates what we call a tax arbitrage, which is a deduction on the side and no taxable income on the other side. A deduction on one side and not taxable income on the other. Let's look at an example. If your business rents your home for $2,000 per day for 10 days during the year, that creates a $20,000 business deduction or a $20,000 tax-free income to you personally. For S-corporation owners especially, this can be extremely powerful because it reduces your corporate profit without increasing your taxable income. But this is very important. The strategy must be implemented correctly. The IRS expects documentation, which includes a reasonable market rental rate based on local venues or comparable properties, a business purpose for each meeting agendas or minutes, proof that business activities occurred, internal payment records from the company, or a rental agreement or written policy. This is very important and it must be followed if you're going to use this tax strategy. If those elements are missing, the IRS could reclassify the payment as taxable income or even as a shareholder distribution. This is why implementation matters more than the idea itself. Also, this strategy is limited to 14 days per year. If you go over 14 days, the rule changes completely and the income may become taxable. At our firm, Upfront CPA, this is exactly what we mean by proactive tax planning. Most CPAs focus on filing taxes when the year is over. We focus on strategies during the year so our clients legally reduce taxes before December 31st. The Augusta Rule is just one example. When combined with other strategies like accountable plans, retirement planning, and entity optimization, the savings can be significant. If you're a business owner and you're not sure whether using all strategies available to you, that's usually a sign that planning hasn't been done yet. If you want to learn more or see whether this applies to your situation, reach out to us. Because smart tax planning isn't about loopholes. It's about understanding the law and using it correctly.